So FHA loans tend to get a bad reputation, like it's only for those with a lower credit score or only for those with no money saved. But the truth is, FHA is not a one-size-fits-all type of loan, and when used correctly, it can open up the doors to homeownership, and when used incorrectly, it could cost you thousands. So in today's video, I'm going to break down everything that you need to know up front so that you can make the decision if an FHA loan is right for you. So FHA is one of the most lenient types of loan programs out there when it comes to credit score, and the minimum credit score that required is anywhere from a 500 to a 580. Now, just note that with a credit score in the 580 or below range, you're going to get, number one, killed on the rate and the fees, and also a lot of times they require you to put at least a minimum of 10% down. So really that next benchmark is going to be a 620, because at a 620, you're going to be able to put down the minimum, which is 3.5%, and you're going to get a decent interest rate as well. Now, a common mistake that I see a lot of buyers making is they automatically assume that if they go with an FHA loan that you're going to get approved below a 620 even if you have a 10% down payment, and that is not always the case. So a good tip is know your credit score, know where it's at right now, analyze it, see if there's a few tweaks here and there, give yourself enough time so that you can get up to that 620 mark, because the higher your credit score is, the better interest rate you're going to be, and also the easier approval. Now let's go over the different income requirements. So when it comes to income, the banks not only look at the amount of income that you're bringing in, they also look at other factors like stability of the income and also consistency as well. With an FHA loan and really most other types of loans, you really need a 2-year work history in order to qualify. Now, this doesn't need to be in the same line of field, doesn't even need to be in the same job, just as long as you have had a job for the last 2 years and you can document that income, that will work. Now, here's where it gets tricky is when you start changing pay structure. So let's say that you're a salary employee, you take a new job, and it's 100% commission. At that time, the bank is going to want to see that you have been receiving that commission income for the past 2 years so that they can, one, determine what your pattern is of this new income type, and two, they also average it out for the past 2 years. Same thing with working as a W-2 employee and switching to a 1099 job. They're going to want to see that you have been working that 1099 job for the past 2 years so that they can determine what the pattern of your income is going to be. And a big mistake that I see a lot of first-time home buyers making, or buyers in general, is they assume that just because they're receiving any income at all, that the bank is automatically going to approve it, and that is not the case. They have very specific requirements when it comes to that. Now, the biggest difference that I see between FHA and conventional, they both follow very similar guidelines when it comes to income. Where they differ is conventional is generally more lenient on those with a large job gap. Now, let's say that you've had a job gap for about 8 months. They will allow you to document and use the prior job leading up to that job gap in order to get you to the full 2 years. So it doesn't necessarily, the 2-year work history need to be consecutive months. FHA is a lot more strict when it comes to that. Also, the big difference with if you're a self-employed borrower. So if you have owned a business for 5+ years, conventional will allow you to only use 1-year tax returns as income, as opposed to with FHA, they require the last 2 years to look at your income. Now, before we go over the next part, which goes over the amount of money that you need to have saved up in order to get a house, make sure you hit that subscribe button so you get notified every time I put a video out. So the minimum down payment that's required is the same if you're a first-time home buyer or not when it comes to an FHA loan. And the minimum down payment is going to be 3.5% of whatever the purchase price is that you're buying. And a lot of times you can use either a grant or down payment assistant program to help cover that minimum down payment, especially if you're a first-time home buyer. There's a lot of options out there when it comes to that. And many people assume that when you're getting a grant or down payment assistance, it's going to be a separate loan type, and that's not the case. It's actually coupled with either an FHA loan or a conventional loan to cover the minimum down payment. Now, a good strategy that a lot of first-time home buyers are able to take advantage of, and actually a lot of my buyers are taking advantage of as well, is they use a grant to cover the down payment. They also ask the seller to cover their closing costs, and that is a way to buy a house with very minimal out-of-pocket expenses. Now, you can't pull this off on every house. You have to have a really good realtor to negotiate the seller to pay for your closing costs, and also you have to find the right seller, because not every seller is going to want to pay for your closing costs, but it is an option and it can be done. So mortgage insurance is one of the most misunderstood aspects when it comes to an FHA loan and how expensive it really is, because you're paying for it in two ways. Number one, you're paying for it in an upfront cost, and two, you're also paying for it on a monthly base. So the upfront cost, it's a percentage. It's 1.75% of the loan amount. So let's say you're borrowing $300,000. Your loan balance added with the upfront mortgage insurance is going to be $305,250. Then you're also going to get hit on a monthly base, and you're paying 0.55% of premium, and they break it down into monthly payments for the full year. This gets added to your mortgage payment, and it stays for the life of the loan if you're putting at least 10% or less down. And a lot of times people don't even realize that there is a upfront mortgage cost. They don't see that it gets added to the loan amount, and so when they go to refinance or to sell the house later on, they don't realize that that gets taken out of the equity. Also, they assume that that monthly mortgage insurance is automatically going to drop off during the life of the loan, and that is not the case. It doesn't work like a conventional loan, which is one of the most downfalls of the FHA loan. Now, a good tip is FHA, because of this mortgage insurance, it's really only good as a temporary solution. Use this loan to get into a house. If you could not, based on other types of loan like conventional, then you can refinance into another type of loan. Now let's go over the property requirements when it comes to an FHA loan. So unlike conventional, FHA is more strict on the condition of the home must be in order for it to qualify. And the reason is it's a government-backed loan. They're insuring the loan itself, so they want to make sure that the home is in safe and sound condition. So if you're trying to buy a major fixer-upper home, then traditional FHA is not going to be the loan type that you want to go with. Now, you can use this type of loan to buy anywhere from a single-wide manufacturer home all the way up to a 4-unit property, but again, the home must be in almost move-in ready condition. And a lot of times people assume that just because they themselves qualify for an FHA loan, they tend to forget or they don't realize that the home itself must qualify per FHA guidelines as well. And here's what ends up happening. Once you go under contract, you're going to have an FHA appraiser come out to the home, and they're going to do their own inspection. They're going to look at, they're not only going to check to make sure that you're not buying the home for less than what it's worth, but they're also doing their own inspection based on FHA guidelines. And if they see any repairs or issues within the home, they're going to call it out, and the seller is going to be required to make those repairs in order to close on the home. Now, typical repairs that needs to be done is anywhere from like peeling paint, leaking roof, broken windows, exposed wirings, shaking handrails or non-existing handrails, and also missing heating elements and any wood rotting as well. Now, here's a tip that some home buyers go with. If they find a home that needs a major renovation, they can do what's called an FHA 203K loan, where you can wrap those renovations into the loan, so you're financing the renovation cost into the actual loan itself. So if you currently own a home with an FHA loan, you need to understand what the 100-mile rule is if you're wanting to qualify for another FHA loan and use that to buy another house, because if you don't understand this, then this could cause your loan to get denied in underwriting. So what this is if you are wanting to keep your current home and rent it out, the next house that you buy, if you're wanting to use another FHA loan to buy the new home, then both of those homes must be at least 100 miles apart in order to qualify. Now, what you can end up doing is you can always buy the home with an FHA loan, then refinance into a conventional loan, and then rent it out, go buy another home with an FHA loan. Or vice versa, buy your first home using the FHA loan, and then the next home rent it out. Then the next home that you buy, you can use another type of loan like conventional or another type of loan that will work as well. So if you have a 620 credit score, stable income, savings and reserves saved up, you're also able to comfortably afford the mortgage payment at the current interest rates and home prices, then it's going to be best to go ahead and buy now so that you can start building up equity. Now, however, if you do not have much savings at all and you're relying on like grant programs and down payment assistance to get you into the home, if you're also stretching yourself as far as the monthly payment and you're relying on a future refinance once rates drops to lower that payment for it to be more affordable for you, then it's going to be best to hold off and not buy now. At the end of the day, you know your situation best. And if you enjoyed this video, then you're going to love the last video that I did that broke down the pre-approval process and everything you need to know about it.